whereas horizontal levels and ranges are useful for identifying probable areas of reversals. Trend lines are useful when incorporating both directionality and an element of time in the analysis. They are similar to horizontal support and resistance, but they are more akin to guide lines showing directionality and strength of market movement. Horizontal ranges and levels only cover the price element on the chart. However, when looking at the strength, direction, and an element of time analysis, the diagonal or angled trend lines provide the vertical element that is needed. As a consequence of these characteristics, trend lines need at least two swing points to reference because they need at least 2 points in time to reference from the x-axis, which represents time. It is a very steep angle of descent, and as discussed earlier, it's not necessary to measure the exact angle. Just by visual inspection, it can be seen this is quite steep. That is in part because the trend line runs through the exact highest points for both the downswings, and that's because the volume at these downswing points is normal or slightly below normal. The points could be lower with slight penetration above the trend line because, similar to horizontal levels and ranges, if there is high volume, especially exceedingly high volume above normal levels, it will be normal for some temporary movement over a descending trend line. So in such a case, if there was high volume at these areas, the downswing points would poke above the trend line slightly, which would alter the angle. Since the descending trend line is steep, it is less stable. It is a strong downtrend, but it could slightly be too much selling in a short period of time. So in the short term, it is not unsurprising to see the trend line being surpassed relatively easily. Volume is consistent but not exceedingly high, and that's similar to how horizontal ranges are crossed with a minor pause. This soon turns out to be a minor bounce indeed. The longer term context is still developing bearish, and the strength is renewed with a downswing forming from the 16,500 resistance. A trend line that hasn't been breached is more valid, so it will be more sensible to readjust the trend line to accommodate the new downswing point. Similar to before, the trend line runs through the absolute high of the downswing because the volume is quite low, and it wouldn't make sense to have the trend line run deeper into this downswing point and the swing point to poke above the trend line slightly. That only commonly happens when there is high volume to temporarily pierce above the trend line. As seen before, the 10,000 to 12,000 range is decisively breached during the developing downtrend, and later that offers resistance to rising price, role reversal of this prior support range. But even if this 10,000 to 12,000 range wasn't identified, the descending trend line is adequate in identifying resistance to rising price. It even adds an element of time where the relative strength of this range as resistance will likely be stronger since there is confluence from the intersection of the descending trend line and this horizontal price range. That's why this developing downswing was highly probable to form at this area on the chart, both in terms of the price range and time range. And just like horizontal levels and ranges, a trend line's validity and reliability can be increased when more swing points run through it. Some familiarity here. Price rises with a very weak upswing because the selling pressure has subsided, in the short term at least, but the recent resistance, in this case around the 10,800 area, is unable to be surpassed immediately, resulting in another downswing and continuation of the longer-term bearish context. And even though the trend line has been breached, it still has influence, as seen by the highlighted purple area as the market slides back down to the previous major support. Moving along, the trend line is readjusted to the most recent downswing. With a zoomed out view of the bigger picture, the full extent of the steep descending trend line is very apparent. And similar to before, when the market broke above this newest adjustment to the downtrend line, there was a minor pause, and as you may have noticed, when a trend line is breached, it often occurs near a horizontal range that has been identified as support or resistance. It could only be said the downtrend is over during the short term when these upswings form, but in the longer term, the market is simply beginning to slow down prior to another drive lower. And overall, the descending trend line, as it has been adjusted, does show when the upswings are likely to encounter more significant resistance at established resistance ranges, especially apparent at the 10,000 to 12,000 area.